All right, well, now we're at the end of the month or quarter or year or whatever accounting period that you happen to be dealing with here. We've recorded the last of our transactions, and now it's time to move into preparing our financial statements. The first thing that we're going to do is prepare something called a trial balance. And there are 3 steps to doing that. You're going to list the accounts, and I'm just gonna go back. So we've got all these accounts here that we just used, and you're going to list those out, and in a second I'll show you what order you're going to list them in. And pay attention to the balances, and again, the balances land on the bigger side. That's what it's going to be the balance and the correct debit or credit side that you're going to want to remember as you're doing this trial balance. And so you're going to list the transactions and then make sure that your total debits and your total credits equal. If your total debits and credits after you've listed everything out are not equal, you should stop at this point and go back and figure out whether you accidentally put something from the debit column into the credit column, or maybe you transposed a number, or what it is you did. Because if you are not in balance at this point, your financial statements are going to be wrong. So there's no point in moving forward into financial statement preparation when you know that your numbers are not good. So here's an example of the trial balance. We start by listing all of our cash accounts. Then we move into listing our liability accounts, and lastly the equity, and we start with our owner's capital and withdrawal, then revenue and expenses. And again, note, all we did is took the balance, whether it was debit or credit, from the individual accounts and just put them in the respective debit and credit columns. And I've just noticed for some unknown reason that my camera has decided it's going to not work for now, but I'm not going to worry about that. We'll just get through this video. So notice at the bottom here that again our total debits and our total credits equal, and that is really the threshold requirement for this, because if we're not in balance here, then we need to go back and figure out what we have done wrong. Now here are some common things that if you are not in balance to go back and check for. And again, the first thing is that make sure that you go back into the ledger accounts and make sure your math is correct. Make sure the ending balance that you took is actually calculated correctly. And then make sure that you moved them over into the proper debit or credit column on the general ledger. And then again, recomputing balances. If you've got to go back to the journal, which is the transaction by transaction, just to make sure that you correctly recorded the transaction that occurred in the journal correctly into the individual ledger. And then also go back then, even if you've done that correctly, then go back and make sure that your journal entry was correct, and that it's possible that when you recorded the initial journal entry you were off, and then that mistake has now managed to carry itself through all the way to your trial balance. So we're going to assume that the trial balance came out okay, and we can now move forward into preparing the financial statements. So our financial statements are, again, what we put together from our trial balance. The the balance sheet represents a point in time. So it's as of whatever, December 31st. Whatever the end of the period is, it's kind of been a cumulative running total as of now. Whereas our income statement and our statement of owner's equity and cash flows, this is going to be a point in time. This is going to show the month of, the quarter of, or whatever. We're not going to have an income statement that shows our revenues from the beginning of our company from time. No, we only want to focus on what we've made. I mean, if you think about your paycheck and you get, hopefully, if you look at your pay stub, you might have a year-to-date figure on that. And then what happens with that figure at the end of the year? Well, that's going to be on your W-2, and you're going to use that to pay your taxes. Your employer then, January 1 the next year, that year-to-date figure is going to go back to 0, because in year 2, you're not going to worry about what you made in year 1 when you go to pay your taxes. You're just only focused on each period's revenue, and that the income statement operates exactly the same way. And we talked about this a little bit in the last chapter, but just to recap the purpose of the various statements, our income statement is, again, our income less expenses. Our statement of owner's equity keeps track of the changes in the owner's equity that as a result of investments, earnings, all of those things, and we'll see that in just a moment. The balance sheet, the accounts that show up on the balance sheet are those that have to, wait for it, balance. Assets equal liabilities and equity. And so that's what's going to show up on the balance sheet, are the balance sheet accounts that go into the balance sheet equation. And then lastly, the statement of cash flows. And that becomes a little bit more complicated, so we're not going to do statement of cash flows now. We'll kind of start with baby steps here. So we begin with the income statement. And why do we begin with the income statement? You'll see in just a second. So we have here our revenues. We've got our consulting revenue and our rental revenue for total revenue of $6,100. We have not too many expenses, but a few, enough for you to hopefully get the idea. So we have $2,705 in expenses. When we subtract the expenses from the revenue, that gives us net income of $3,395. And boom, our income statement is done. We can move on to statement of owner's equity. Now, those are pictured here because part of what goes into the statement of owner's equity is this net income figure. So we start the statement of owner's equity showing the beginning balance, which at this point was 0 because we started the company this month. So he didn't have a balance that was left over from last month. We start fresh. He invested his $30,000, and he gets to add to that the net income. So total additions to his owner's equity were $33,395 this month. But wait, he took some out. So he took out that $200 withdrawal. So his ending owner's capital account, owner's capital ending balance is $33,195. And that will be the starting figure. I don't know where my mouse went. So this ending balance here next month will appear as the starting balance for next month. And then again, if you put any more money in next month and had earnings, all of those things will go through this exercise again, and this number will change based on next month's activities. So now we've got our balance sheet, and our statement of owner's equity is shown here, and again prepared second, because now we're going to use this ending number off of our statement of owner's equity to plug right in to the balance sheet, lo and behold. And we have hopefully added up all of our assets from our trial balance correctly, and I may just hop back really quick to that. So you can see that these were all of the assets that were listed, and we've got our liability. And then the owner's equity, again, was something that we calculated from these items below. So again, here we are now. You see all those assets listed here. You see those couple of liabilities here, and you see the equity that was calculated above using our statement of owner's equity. And lo and behold, our assets equal the total of our liabilities plus owner's equity. In terms of presentation issues, we don't use dollar signs in the journals and ledgers. They do show up in the financial statements and trial balances. You will only put the dollar sign at the top and at the bottom. So the first number you list in a column and the bottom, get a dollar sign, and then don't worry about the rest. Now, one of the things you can do once you've prepared the financial statements is begin to evaluate a company's performance or a company's financial health. And these ratios, which we will revisit throughout the semester, are ways that you can do that. This particular ratio, the debt ratio, is a way that you can look at the level of debt risk. In other words, how well a company is poised to be able to pay its debts. The higher the ratio, the greater the probability they can't pay. And if you think about that, you look at the ratio and you think, okay, total liabilities over total assets. Liabilities are what we owe. Our assets are our resources. And if the liability number gets too high and the asset number gets too low, that ratio starts to climb, and yeah, we could definitely be in trouble the higher that number gets. We can use this ratio to compare, ideally across industries, what is considered a high ratio in one industry may be not so high in a different industry. So you want to make sure that you're comparing apples to apples when you're comparing ratio, or when you're using these ratios and deciding how you're evaluating a company based on them. But we know that they were, because they were all prepared using generally accepted accounting principles, that the numbers were arrived at using the same methodology, but how you interpret them will be different across industries. So here you see we've got Costco and Walmart. We've got 2 years ago, 1 year ago, and this year. And you will see that the debt ratio for Costco continues to go down. Meanwhile, the debt ratio for Walmart goes up. So when we look at risk of, and not to say that Walmart is in financial trouble at all, but when you begin to look at this, you can say, okay, well, Costco is poised to be in a better situation to pay its debt than Walmart might be in the event of the need to have a liquidation or something. And that concludes Chapter 2.